video, we're going to be looking at an advanced transaction involving the sale of inventories. So let's look here to start. On September 1, Johnson Shoes sells a pair of socks for $11. The business paid a supplier $5 for the socks, so that was the cost price. So a business bought a pair of socks for $5 and then sold it to a customer for $11. To process this journal, we need to split this into two separate things. So firstly, it's the sale of the socks. So let's deal with that first. So I'm going to say here the sale. So the sale of socks, what accounts are involved? Obviously, we're going to have some sales. We're also going to have cash at bank involved because we received $11, and there's also going to be some GST implications. So GST collected, because we made some sales, we've collected some GST for the government, so GST collected. The second half of the transaction says the business paid $5 to the supplier for the socks, so we need to account for that as well. So I'm going to put here the cost. So how do we account for the cost of the socks? Well, two accounts are affected here, and they are cost of goods sold, which is an expense account, and our inventories. Inventory or our stock levels. Our stock's reduced because we've sold some of our stock. Alright, so they're the 5 accounts that are going to be affected in this transaction. So what we now need to do is process them in our transaction table. So the date is September 1. Let's deal with the first 3 accounts first. So sales. Sales, we know obviously is a revenue account. Nature of revenue accounts, they're credits. Our sales have gone up, so it's going to stay a credit. For the amount, now the amount is the ex-GST sale amount, so we need to go $11 and times that by, so divide it by 1.1. Put that in your calculator, you'll get $10. The next account is our CAB, or our cash at bank account. Our cash at bank is an asset by nature. Asset accounts are debits. Our cash at bank's gone up. It's going to stay a debit for the full amount that we received, which was $11. Our last account affected was GST collected. Now GST collected, if we look over here at our chart of accounts, it's down here in the liability, so it's a liability account. Liability accounts are credit by nature. It's gone up, so it's going to stay a credit for our GST amount. So GST amount on $11 is going to be $1. We just divide 11 by 11. That's going to get us $1. If you do a quick check here, see our debit of $11 equals our 2 credits of 10 and 1. This journal entry isn't finished, or this transaction table isn't finished. We need to account for this last little part here, the cost price of those socks. So the 2 accounts affected here were cost of goods sold. Cost of goods sold is in the expenses section, so you can see it here, cost of goods sold. Cost of goods sold is an expense. Expense is a debit by nature. Our expense accounts has gone up, so it's going to stay a debit for the cost price, which was $5. The final account is going to be our inventory account. Our inventory account is an asset account. Assets are a debit by nature. This time, because we've sold inventories, our inventory balance has gone down, so this is going to decrease. So that's going to switch from a debit to a credit of $5.